Long-term loans are only 0.47 in comparison to shareholder funds. Okay. Next, proprietary ratio. Formula: equity upon total asset. Proprietary fund or shareholder fund or non-current asset plus current asset. A higher ratio is sound indicator of financial position of the company. Here, to calculate proprietary ratio, following information has been given. Equity share capital, that is your 30 lakh. Preference share capital, that is your 1 lakh. General reserve 18 lakh. Profit and loss balance 12 lakh. Debentures 3 lakh. Trade payables 1,60,000. Outstanding expenses 40,000. The formula: proprietary ratio, equity upon total asset. So that is 7 lakh upon 12 lakh. It will be 0.58:1, or we can say 58.3%. The 58.3% of the total asset of the company are funded by equity, which indicates that long-term financial position of the company is very sound. Another one, interest coverage ratio. Formula: profit before charging interest and income tax upon fixed interest charge is equal to time. An interest coverage ratio is 6 to 7 times is considered an appropriate. It indicates how many times the interest charge are covered by the profits available to pay interest charges. From the following details obtained from financial statement of KX Limited for the year ended 31st March 2017, calculate interest coverage ratio. Net profit after tax is 6 lakh, 40 lakh plus 12% debentures of 100. Each tax rate is given 40%. State its significance also. Will the interest coverage ratio change if during the year 2017 to 18 the company decide to redeem debentures of 5 lakh and expect to maintain the same rate of net profit and assume that the tax rate will not change? Here is the solution. Interest coverage ratio: net profit before interest and tax upon fixed interest charge. In the above question, net profit after interest and tax is given, whereas profit before interest and tax is required to calculate this ratio. If profit after tax is 60, the profit before tax must be 100. If profit after tax is 6 lakh, the profit before tax must be 60. 100 into 6 lakh, that is your 10 lakh. Add interest at the rate 12% on debentures of 40 lakh, that will be your 4,80,000, and net profit before interest and tax, that is 14,80,000. So the interest coverage ratio is 14,80,000 upon 4,80,000, that is your 3.08 times. This indicates that firm will not able to pay interest on long-term loans and regularly, as its interest coverage ratio is only 3.08 times. Note: net profit after tax means net profit after interest and tax. Significance of interest coverage ratio: it reveals the number of times interest on long-term debt is covered by the profit available. A higher ratio ensure safe of interest on long-term debts. The interest coverage ratio will improve the company to decide to redeem 5 lakh debentures, assuming the same rate of net profit and tax rate will be same. Thank you.